Okay, welcome to the present. It's July 2020, and what we're going to try to do now is talk a little bit about coronavirus and how it's affected the U.S. economy. I could go incredibly in depth on this if we wanted to. I could do an entire class on the coronavirus and the government response, the Federal Reserve response, but I don't want to do that now. I just want to keep this as short as possible, just to give you a taste of what's happening right now and stay out of most of the complexities. What I'm going to try to do basically is just tie in information that we already know into what's going on right now and try not to introduce much new, okay? So in regards to the coronavirus, as you know, back in January, we really didn't know this was going to be a thing. Come March, we're canceling schools, canceling sports, canceling everything, and it all happened very quickly. And it's really an unusual situation. We've never really had anything like this to affect our economy. And you might be tempted to go back and say, well, what about 1918? What about 1919, right? That's when we had the Spanish flu. 2 million people died, I think, in the United States. That was way worse. But the thing is, we didn't really understand what was happening then. The science just wasn't there, and certainly our economic logic wasn't there. So this is the first time that we've seen the government and our monetary system try to figure out how to navigate a pandemic. So if we think about the effects, really we see this on all sides of the economy. Okay, so we can start with the supply side. Right? We've talked about this before, how the economy can basically be divided into the supply side and the demand side. Classical economists would largely focus on the supply side of the economy. They believed in Say's law, supply creates its own demand. So if you just focus on supply, that will be enough to generate demand. So in regards to the U.S. economy, we have this huge reduction in employment. Or to say that another way, this huge increase in unemployment. So if we normally think of the natural unemployment rate as being about 4.5%, we're way above that right now. So if we just go back in time here a little bit, we take this just back to February. Man, February, what a different time it was. It was not very long ago, but just back in February, we had 3.5% unemployment. The economy was absolutely steamrolling. This is actually the lowest unemployment rate that we've had in my lifetime. Very, very low unemployment rate. So the economy was very strong. We could talk about whether it was strong for good or bad reasons, but the bottom line is it was strong, okay? But if we take this forward just a couple of months, we see the effects. So in March, we get an increase from 3.5 to 4.4%. And that in and of itself is actually a pretty big increase month over month, right? 0.9% increase in unemployment. That's big. But based on the fact that you probably already know where we're going with this, that suddenly seems very small. Because if we take this just forward one more month to April, we reached a 14.7% unemployment rate. That right there is the highest unemployment rate since the Great Depression, since the 1930s. So an unbelievably high unemployment rate, and the biggest increase month over month in all time as well. So I don't think we'll ever see an increase like that again in our lifetimes. I guess the only reason that would happen is maybe war, but probably not. War usually doesn't cause a lot of unemployment. I really can't think of anything except something like a pandemic that would lead to such a huge increase in the unemployment rate. So April is when that first wave hit, right? There was a lot of uncertainty because we didn't really understand how the coronavirus worked. We didn't really understand if something like a vaccine was feasible. Now it seems like a vaccine probably will happen, but it could be a while, right? So if we just take this forward a couple more months, May, we're still at 13.3%, June, 11.1%, and that's as far as the data go right now. So we've seen a little bit of a pullback in regards to the unemployment rate, but still this rate here is higher than any point during the Great Recession of 2008 to 2010. This is higher than the late 70s, early 1980s when the economy was really bad. So we're still really in unprecedented economic times. The good news is, however, that of course this is driven by the pandemic. And for the most part, it seems like the economy would do well if the pandemic could somehow just suddenly end. I say that because if we go back to 2009 in a way economically was more troubling than today is, because it does still seem like the economy is doing well considering the fact we're in a pandemic. So it's not all bleak. But nonetheless, the unemployment rate incredibly high. So if we think about this from the supply side, right? Supply looks at production. The supply side is basically telling us here that production is incredibly weak, right? If there are so few people working, then the economy has to be producing below its full potential. The real GDP has to be much lower than the natural real GDP. And there's nothing to stop that from continuing until we figure out a way to completely get past this pandemic. And that could be a while. That's not the only major supply side effect. You also have these large supply chain disturbances. And this is what we saw right at the beginning of the recession. You know, all the way back, really even into February here, what happened was China first started seeing these cases of the coronavirus, of COVID. And as a result, we couldn't get stuff shipped from China. So if you're a company that needs raw materials from China, it's really hard to get them, right? Impossible to get them during this period right in here. So you get these major supply chain disturbances. And this is probably going to be a lasting legacy. This is going to take a while for this really to finish. Right now in the United States, our COVID situation is relatively bad compared to the rest of the world. And you're not allowed to travel to a lot of other countries. This is going to create supply chain disturbances, right? If you, right now, if you typically go to Canada for meetings or to sell items or whatever, well, a lot of that trade right now is just not allowed. So you're going to get these supply chain disturbances, which basically is suggesting that if you're trying to produce a good, there's going to be some steps along the process that are going to be hindered by the fact that we can't travel, we can't ship goods as easily as we used to, okay? So this is all the kind of thing that you might expect to be concerned with classical economics. If supply creates its own demand, then the supply side of the economy is going to create recessions, create economic uncertainty. But it's not just the supply side here that's affected, okay? So let's take a look at demand. Demand is people's willingness to buy goods and services, essentially. So let's think about what's happening to demand. On the demand side, we've seen a big reduction in wages. And it's not just that people are becoming unemployed, but people's wages are going to go down even if they keep their job, right? It's going to be harder to sell goods and services right now for the most part. There are some businesses doing okay, but for the most part, our production is down. GDP and wages, GDP and income have to be equal. If I sell an item that's worth $100, I earn $100 in income. So production and income have to be the same. So if we know that GDP is going down, we know then that wages have to go down. When wages go down, we know the effect. Wages go down, demand goes down. So now we have demand side effects, right? It's not just about the fact that it's hard to produce right now. It's also that consumers aren't willing to buy the good. Investment returns are lower. This will drive demand down as well. When the coronavirus first started affecting businesses, we saw this huge reduction in U.S. stock market valuation. I think the S&P 500, which tracks the 500 largest companies in the U.S., dropped something like 35% over like just a few weeks. It's a big drop, right? And it has crept back up a bit. But basically what this means is if you have a lot of money invested in the stock market, you're less wealthy now than you were at the beginning of the recession. So are you likely to go out and buy a new house or buy a new car when your wealth has gone down? Probably not. So the result is, as investment returns go down, demand also is going to go down, okay? Again, that's a demand side issue. It's not just about producing goods being a challenge. It's now telling you that selling goods is a challenge as well. And then perhaps a more subtle thing to consider is the effect of uncertainty, okay? Whenever things are uncertain, people tend to clam up. They tend to change their behavior, right? If I told you right now there's a 20% chance you're going to die of COVID in the next year, that would absolutely change your behavior, right? Well, the economy is the same way. The economy is adversely affected by uncertainty because most people do not like risk. I'll give you an example, a real-world example. I was actually trying to buy a house when COVID hit. And now, even though I could still afford a house, I haven't lost my job or anything, I just don't want to. I'm scared. right? I'm scared that I could lose my job in the future. I'm scared about what could happen in the economy. I'm also thinking that maybe housing prices will go down, so I want to wait. For those reasons, I'm not buying a house right now. A lot of people are like me. When there's a lot of uncertainty, demand goes down. So if we think about this, we've got the supply side of the economy that's adversely affected, which aligns with classical thinking, that the supply affects the economy. We also see a reduction in demand, which is aligned with Keynesian policies, right? That people's willingness to spend, which is governed by things like how much money they have and how confident they are in the economy. Those things right now are really shaken by the coronavirus, right? So demand is down. So if we think about Keynesian economics, we can use the current situation to fit inside the idea of Keynesian economics, just like we can use it to think about classical economics. And to add one more sector of the economy, right? Obviously, there's just supply, and then there's demand, right? There's really only two sides of the economy. But what facilitates a lot of what happens in between is our financial system. Our financial system refers to our lending system, right? Our loanable funds markets. And we know that the Federal Reserve largely governs our financial system here in the United States. So this is another big area of concern. Basically what you have right now is banks are scared to loan, and consumers are scared to borrow. And I'm writing these up here, but thankfully this so far has not been a big problem. But it's a major potential concern. Okay? Think about it this way. If banks have a bunch of money but they don't want to loan it out, that is going to greatly harm our economic growth. If banks aren't making loans, new businesses aren't starting, new houses aren't being built, people aren't buying new cars, et cetera, et cetera, et cetera. Basically the same idea. If consumers are scared to borrow, if people aren't going out to borrow money to get a house or to get a new car or whatever, go to college, that's going to greatly hurt economic growth. So you basically can think of it this way. We've got three parts of the economy that are in flux right now. You've got the supply side, the production side of the economy. The U.S. government is going to try to figure out a way to influence production. The Federal Reserve is going to try to figure out a way to influence production. We've got the demand side of the economy, right? People really aren't willing to spend right now like they usually would. Thankfully, it hasn't been that bad yet, but if this continues for a while, people will stop buying all that stuff on Amazon, right? They may even stop making their mortgage or rent payments. Now you've got a massive issue in the demand side of your economy. So we got to worry about demand, people's willingness to spend. Again, the government or the Fed is going to have to do something to fix that. And then thirdly, we've got our financial system, which we know is really important. 2009, just look back 11 years, when our financial system collapsed here in the U.S., that was a complete economic disaster that took a long time to get past. So we have to look into the future and make sure that we're taking care of our financial system. So what are we going to do? Federal government's going to have to do something. That's Keynesian economics. Monetary side of the economy, Federal Reserve is going to have to do something. That's monetarism, right? That's the money side of the economy. So I'm going to try to take you in the next video on to see what happens. So you're the federal government. You see this horrible economic crisis potentially unfolding back in March. Again, the uncertainty here is really large. It's July right now, but the uncertainty is still really large. We don't know what's going to happen. We don't know if there's going to be a vaccine. We don't know if there's going to be some sort of second or even third wave around the winter. We don't know what's going to happen. We don't know if we're going to have school, right? I mean, things are very chaotic right now. So the federal government's got to try to do something to stimulate the economy. First of all, is this classical or Keynesian way of thinking? Well, it's Keynesian. Classical economics here really gets thrown out the window. If we do nothing, the economy is going to collapse. So what we see is the federal government is going to take a strong Keynesian approach to dealing with this pandemic. And I really don't think they had much other option, to be perfectly honest. So the goal here is going to be to quickly stimulate the economy. And it's different from other types of economic crises like the financial collapse and the Great Recession of 2008 to 2010. Then it was kind of like you had certain sectors of the economy that were really struggling and you're trying to stimulate them. what the government is doing now is kind of like just trying to keep the economy moving, right? The economy was doing great, and then we had this huge collapse. And what the government's trying to do is try to make it look like that drop never happened. Keep people engaged in spending, keep people working, figure out a way to keep the economy afloat, okay? So I use the word stimulate, but it's not about trying to pick up the speed of the economy. It's more about stimulate it to maintain where it was before, okay? To try to do this, you got to think about some potential problems here. Some of the problems associated with expansionary policies. You can see why I like doing this in the very last lecture, because we're bringing up all this old content, right? We talked about, in Chapter 11, problems with expansionary fiscal policy. We talked about lags. We talked about crowding out. And we talked about debt. And so the goal here is to avoid all three of these things as the best you possibly can, right? There's no way to avoid them completely. So we might think about the policies the U.S. government has taken and see how they did. Did they accomplish the goal of stimulating the economy without some major adverse consequences? Well, I'll jump right ahead to what happened. In 2020, we passed the coronavirus aid. I don't really care if you know the exact name of this, but just in case you see it listed somewhere, you'll know what they're talking about. This was the Coronavirus Aid, Relief, and Economic Security Act, which is anagrammed as CARES. Okay, so if you hear people talk about, they always got to do some stupid acronym, right? So if you see somebody talking about CARES, this is what they're referring to. If we go back again to our last recession in the U.S. economy, back in 2008 to 2010, we passed the American Recovery and Reinvestment Act, where the U.S. government spent like $830 billion. At the time, $830 billion was a lot of money, but it is dwarfed by what the federal government is doing right now and what they've actually already spent. So far, as of this moment, the federal government has already spent $2.2 trillion. And this is $2.2 trillion in new spending. I'm not saying the federal government is spending this amount in 2020. No, this is what's in addition to what they had already planned to spend. The U.S. government had already planned to have this major deficit, but they're going to add on top of that with this $2.2 trillion in spending, which of course, this money is coming from borrowing, right? Borrowing is what's going to facilitate this $2.2 trillion in spending. The idea is you've got all these people that are going to be unemployed. Let's try to figure out a way to keep them engaged in the economy. Try to keep them spending money. Try to keep them being able to afford their rent and mortgage payments and so forth, okay? So they passed some pretty interesting bills here. You may have heard of the Paycheck. Man, my handwriting's terrible. It's been so long since I've taught. Sorry. There's the Paycheck Protection Program. This is the PPP. You may hear this referred to. I'm just going to go through some of the bigger things that were in this bill. This Paycheck Protection Program basically allowed small businesses the ability to get a loan from the government to continue paying their employees. So if I'm running a restaurant, for example, I might be tempted just to lay off all my workers and say, why have workers if we're not producing any food? What this Paycheck Protection Plan did was it allowed those small business owners the ability to get money from the federal government to continue paying their employees. And as long as they kept paying their employees and didn't shut down, they could turn that loan into a grant. So a lot of people who had small businesses took advantage of this. There were some problems. Some people basically couldn't figure out a way to apply for a loan fast enough to get it. The government was bogged down with so many people putting in calls trying to figure out how to get this money that some people just weren't able to find the money. But nonetheless, it still worked as an expansionary policy. You're getting money out there into people's hands that need it. So there was the Paycheck Protection Plan. This Paycheck Protection Program cost the government about $350 billion. On top of that, the U.S. government did about $300 billion in the stimulus checks, if you recall these. It's crazy how this seems like it was so long ago now. It's just a few months back, the U.S. government gave basically all adults $1,200 and all dependents $500. There are rules about who could qualify. A lot of you, if you're a full-time student, you probably didn't get anything, which is really unfortunate. But the idea here was to get money to people who really needed it. The U.S. government decided, I guess, that you don't need it. Kind of a strange plan, right? To not give money to people in their early 20s. Nonetheless, this was a big deal because it gave money to people who basically otherwise maybe would not want to spend money. There's some discussion about doing this again, but as of the time of me teaching this, this has only happened once. There's only been one round of these stimulus checks. There's also $250 billion in new unemployment benefits, so that people who are unemployed could get an adequate amount of money to, again, survive and continue participating in the economy. So this is just part of what the U.S. government has done so far. We might think about, how did they satisfy these? Did they avoid lags? Well, they were actually pretty quick in spending this money the first time around, so I think they did a pretty good job of avoiding lags. Remember, a lag is just the fact that a lot of times it takes the government a long time to enact new policies that make a difference. But in this case, I think they did a pretty good job of getting money out there. The concern is that they seem to be slow with getting this second round. The U.S. government has basically hinted at the idea that they're going to do more stimulus checks, probably a second round, but they've been very slow to do so, and a lot of economists have been critical of that. Most economists that I know, most economists I talk to think the government probably should be more aggressive right now. Crowding out. The U.S. government, I think, has done a pretty good job of not crowding out, largely because businesses right now aren't doing much. Usually the concern is if the government starts some sort of new operation, if it decides it's going to build new roads or something, that's going to crowd out private businesses. But in this case, private businesses are producing so little, especially back in April, that the government spending money is really not going to cause much crowding out. There's one counterexample, though. You've probably heard of this. You've heard that some people would earn more money if they were unemployed than they do right now if they were employed. So some people are quitting on purpose. That's dangerous, right? When you got people quitting on purpose to get government handouts, that's clear that the government is hurting the private sector. If the private sector can't find employees because they're quitting to get the unemployment benefits, that's a big negative. I don't know how to solve that problem, but I'm just saying that it's there. And then thirdly, we might think about, has the government done a good job of avoiding debt? Definitely not. But how could they, right? How could they avoid debt? Most of the videos I've shown you so far have been from 2018, and this is just going to show how much we've changed. Our total debt right now for the U.S. government is $26.6 trillion. That comes from the federal treasury, all right? So it's the data the government itself is putting out. And that is an increase of $3.5 trillion since the beginning of this year. So if you just go back to January to right now, July, our debt at the federal government has increased by $3.5 trillion. Obviously, that's the biggest government deficit in the history of Earth. So that's massive, right? And as an economist, I don't have such a problem with this. What I have a problem is why we're here to begin with. Why was the government taking on debt the last few years when the economy was so strong? That's where I have more of a concern. But spending it now, I think, is very justified. If they don't spend it now, the economy is going to collapse. Of course, our total debt is not always the best way to think about things. Again, calling back on old ideas. I hope you guys remember this term here, the net public debt. The U.S. government owes itself money. When the government has a surplus in one part of its budget, for example, the U.S. government typically has a surplus in Social Security. The government has been borrowing that money from Social Security and spending it elsewhere, okay? So in a way, the government owes itself money. This total debt is really an inflated version of debt because it includes the money that the government owes itself. We talked about this back in Chapter 11. So net public debt is just the debt that the government owes to outsiders, outside of the government itself. And its total value now is up to $20.6 trillion. So in other words, the net public debt right now is higher than the total debt was just 2 or 3 years ago. That's showing how fast this is growing. And that net public debt has gone up by $3.5 trillion just this year. So what that tells you is that the government borrowing that's occurring now is outside borrowing. It's true debt. The government has basically run out of funds to spend that it had from surpluses elsewhere. It's run out of money that it can grab from itself. To use an analogy, maybe I have money sitting in a piggy bank at my house. Well, I've already used all the money out of the piggy bank. And so now if I'm going to get more money, I got to borrow. That's where the U.S. government is right now, okay? To finance any more spending, it has to borrow. So we can think of the government doing a pretty good job avoiding lags, a good job of avoiding crowding out, but the big problem area here is debt. U.S. government debt right now is increasing at an incredible rate, and the only way that that's going to stop is if we either let the economy collapse, which is no good, or we figure out a way to make this pandemic end, and let's hope that happens. All right, and to wrap things up here, we're going to talk about the Federal Reserve and what it's been doing. This is the one I'm really tempted to spend a lot of time on, but you guys got a test coming up. I'm just going to try to be quick here and go through this, okay? If you really like what we're talking about now in regards to the Federal Reserve, like we discussed in Chapter 13, if you like hearing about the coronavirus and the government and Federal Reserve response, you might consider taking Money in Banking, which is a class I offer in the spring. If you're not interested, obviously, don't take it. But that Money in Banking course, we really dive down into more in depth on these issues. So anyway, let's think about the Fed, okay? If you're the Federal Reserve right now, things are incredibly complicated, okay? The problem is you don't know what's going to happen in the banking sector. There could be a financial collapse. You've got the concern that people might stop paying mortgages, right? If you stop making your mortgage payments, money stops coming into the bank. Well, now you're back in a period like 2009 where you've got this collapse in the housing market, which bleeds into the banking sector. You could have a big mess, okay? At the same time, you've got the federal government who's outside of your control. You don't know what the federal government's going to do. If they spend a lot of money, maybe the Federal Reserve doesn't need to do so much. Anyway, it's all very complicated, okay? So to simplify it, here's what the Federal Reserve is thinking. They want to stimulate the economy, right? If we want to make it as simple as possible, that's what the Federal Reserve wants to do. Stimulate the economy. The best way to do that is to increase the money supply. Just last class, right? We talked about the 4 ways to increase the money supply. You can do open market purchases. Let's see, open market purchases. You can reduce the required reserve rate. You can drop the discount rate below the federal funds rate. And of course, you can do the 4th one, which is usually their primary policy here. You can target a low federal funds rate. So you got 4 policies, all right? Those are the 4 big ones. There's some other stuff the Fed can do, right? But these are the 4 big ones that we covered back in Chapter 13. If you didn't watch that video, go back to Chapter 13 because this isn't going to make any sense unless you already understand how this works, okay? So, one thing the Fed could do is buy stuff. Have they done that? Absolutely. The Federal Reserve has been incredibly aggressive. They've spent about $2.3 trillion in direct spending, buying up things like mortgage-backed securities, buying up mortgages, buying up federal government debt. The federal government now owes the Federal Reserve an extra, I think, $500 billion because of the borrowing that the federal government has basically sold off to the Federal Reserve. So the Federal Reserve has been buying a bunch of stuff, $2.3 trillion. And they've been doing a lot of other things that are similar to this that I don't want to get into in this class. But the Federal Reserve has never been this aggressive. They're spending more money than they did even back in 2009. Another thing they could do is lower the required reserve rate. I believe when I taught this, I said the Federal Reserve has never done this, but it's something they could do in the future. I thought I might die with that never happening. Well, they did it. They lowered the required reserve rate. In fact, the current required reserve rate in the United States, as of March 2020, it was dropped to 0%. 0%. There is no required reserve rate right now in the U.S. What that means is banks can choose to loan out every penny that they have if they want to. So that should stimulate the economy because the banks now can make more loans. This should stimulate the economy because banks now have more money that they can loan out. So you've got these things that help the banks and in turn should help the economy grow as fast as it possibly can. Okay? All right, so they did open market purchases. Check. They lowered the required reserve rate for like the first time ever. Check. They could drop the discount rate below the federal funds rate. Check. They did this as well. The discount rate now is essentially at 0. The discount rate is about 0.25%, which is as low as they ever take it. So the discount rate has been dropped. So they've done this one as well. This last one here, target a low federal funds rate. What do you think? You think they've done that too? Absolutely. We should remember that the way they do this is by engaging in these other 3 actions. So of course, the federal funds rate is going to drop as well. So the federal funds rate in the U.S. right now is between 0 to 0.25%. So the Fed has done everything it possibly could do to try to lower interest rates, increase the money supply, and in turn stimulate the economy. They've basically done all they could. Here's kind of the scary thing though with the Fed. This happened back in 2009 as well. Let's think about what the Fed could do now if they wanted to. So let's say the Federal Reserve realizes the economy is going to be even worse in the future. It looks like a vaccine is not going to happen. It's December and people are catching COVID like crazy. Now think about what the Fed can do. What they would normally try to do first and foremost is figure out a way to lower the federal funds rate. Can't really do that. It's already at 0. They could push it negative. That's sort of an advanced topic, but they're probably not going to do that. So they've essentially, basically, if you think of it this way, the Fed has 4 bullets in its chamber, right? These are the 4 things the Fed can do with its gun. It's got 4 things. Well, one of those bullets has already been shot, okay? This one too. Drop the discount rate. You can't do that. That bullet has already been shot. No way to get another one back in the chamber until those rates have been lifted back up. They can't lower the required reserve rate either. It's already at 0%. And so now the Fed is back in a precarious position just like it was back in 2009. It has 4 bullets. 3 of those bullets have already been fired. The last bullet remaining is open market purchases. This is the only thing the Fed can really do anymore to try to stimulate the economy. So the Federal Reserve has basically limited itself. It's only got one thing it can do, open market purchases. The federal government has built a tremendous amount of debt. So it's kind of a scary position that we're in right now. The federal government and the Federal Reserve have basically already done everything they can possibly do. The only thing the federal government can do is keep on taking on more debt. Good for the short run, but we know, has adverse consequences in the long run. The Federal Reserve can keep making open market purchases, but do we really want the Federal Reserve to just own tons and tons of assets in the United States? That seems kind of like a scary position to be in. So despite the fact that the economy is not so good, we do think that what we've been doing with the federal government and the Federal Reserve have made things better. But the concern is, how long can we do this? How long can the government and the Federal Reserve continue to keep our economy at a point where it's not completely collapsing? I don't know the answer to that. I'm hoping that things will be okay. But really, honestly, right now in July, things don't look so bad. The stock market has rebounded, which usually means that's usually a good thing because that means people are optimistic about what's going to happen in the future. But we don't really know. So if you really want to know more about this, again, you can take extra classes. Keep your eye on the news. It'll be interesting to see what the federal government does now if they try to create a second set of stimulus checks. But everything really right now is in flux. So as of July 2020, here's where we stand. Who knows where we'll be a year from now.